Let's change now to the big fat idea. I've got Kyle Green, president of the Green Mortgage Team, joining me on the line right now. Kyle, thank you for joining me, and let's start right into it. What's the big idea?
The big idea that I have is looking at refinancing and pulling out equity to invest, and that can be investing in real estate, stocks, mutual funds, whatever you want, but borrowing at all-time low interest rates to invest seems like it's a really popular idea right now.
So, in other words, you've got some equity sitting in your home, and so you can borrow against that equity. And let me just ask you very quickly, how much does that cost right now? What's the interest rates if you take out a second mortgage, as it were?
Yeah, so to borrow money on a line of credit, it's prime plus 0.5, which is 3.2%. If you're borrowing it on a mortgage, then you're looking at 2.5% or lower. Low interest rate terms like 2-year or variable are around 2.2, 2.3% right now.
Okay, so let's talk more about this. Give me, you've already alluded to one. You got record low interest rates would be one of the reasons you'd look at this kind of a strategy. Anything else?
Yeah, when you borrow funds to invest, the funds are actually tax deductible too. So you're actually creating a tax deduction for yourself that you wouldn't otherwise have. So some of our clients will actually have cash that they want to invest, and if they still owe money on their mortgage, sometimes they'll actually we'll advise them to pay down their mortgage, re-borrow the funds, and now they've created a tax deduction they didn't have. So the fact that you can write off the interest is a really interesting key right now too.
Okay, let's and again, let me come back just a little bit. How difficult is it to set this up?
You know, it's not that difficult. We've had a lot of clients who fully paid off their mortgage. They've been paid off for years, and what they're finding is that their investment returns are dropping year over year, and they can't really rely on that anymore. And so a lot of people now are dipping in and refinancing. It is becoming a little bit more difficult than it used to be, but for strong applicants, the money is still there, and it's not that difficult to obtain at least a few $100,000 from your home equity.
Who do you consider this appropriate for? I'm thinking in terms of risk.
Yeah, I would say that this is a higher medium risk because you are borrowing funds. And so if the return on the investment is below the cost of the borrowed funds, you need to make up for that.
Sure.
So this only makes sense if you have investment options that are substantially better returns at a relatively low risk. So personally, I'm a fan of investing in private mortgages. Typically, you can invest in funds that invest in second mortgages for individuals who can't get financing through banks, which is becoming more and more popular nowadays as banks are tightening up. And the returns are typically about 6 to 9%. So people are borrowing their money at around 3%, investing into these funds and getting a return of 6 to 9% and creating a spread on money that they just borrowed from one source and lent to another.
So obviously, I mean, the whole key there is to make an assessment with your financial advisor. Is this what's the probability of this investment continuing to yield higher than the cost of the money you're taking in, or you're paying out rather, the money on the loan, the interest on the loan, it's got to be less than the money you're getting from the interest on the on the investment you've chosen. Just quickly, how long do you think you'd have to hold something like this, or what should you plan? I mean, it's not like you're going to do it 1 week to the next.
Yeah, that's a tricky one. So it really depends. And the beauty of this type of product is you can convert and lock in portions of this line of credit into mortgages. So if you invest into a fund that has a 5-year time horizon to get paid out on, you can lock in your funds into a 5-year fixed at around 2.5%. Mm-hmm. So it really depends on what you're investing in. If it's a short-term turnover, then you may want to keep the money on a line of credit and pay interest-only payments on it, so you can pay it off in full when the fund pays out. But you can also lock into 1 to 10-year terms to have the mortgage money line up with what the expected payout of the investment is.
Good stuff, Kyle. It's another example of how record low interest rates impact on a lot of areas. Kyle Green is president of the Green Mortgage Team. You can find him at www.greenmortgageteam.ca. Thanks, Kyle.
Thanks.